The last few years have shown us how difficult it can be to predict inflation. Central banks often miss the mark in their forecasts. We can put a bit of the blame on volatility. The more volatile things are, the easier it is to get things wrong. But they've not really had the best record over the last few years. But at last, at least in the US, it seems like inflation is heading back towards the Federal Reserve's target area. So they should be giving a sigh of relief now, right? Well, no, because as one policymaker recently said, there's still more work to do. Now, that could make it a bit more difficult for the economy to have a soft landing. When the central bank wants to slow inflation, they'll usually have to slow economic growth by increasing interest rates. A soft landing means the Federal Reserve does manage to slow inflation, with the worst outcome being maybe a mild recession, but the alternative is a hard landing, where there's a much deeper recession and more people lose their jobs. This becomes much more likely as inflation remains high, since the Federal Reserve will need to slow down the economy even further to slow down the inflation. One of the biggest threats for inflation right now is wage growth. Wage growth is a bit of a sensitive topic for the general public, because whenever the topic of inflation and wage growth comes up, it's generally seen as being unfair. Like, why shouldn't wages rise in line with inflation? So, according to the Fed's wage tracker, wage growth was just over 5% for August. That's relatively high, and the Fed are likely to view this as being inconsistent with their inflation target. Why? Because if wage growth outpaces inflation, creating real wage growth, it could result in more consumer spending, leading to demand-driven inflation as opposed to supply-driven. Now, this is sometimes referred to as sticky inflation because it's much more persistent. According to Matt Klein, a well-known economics journalist, for wage growth to be consistent with a 2% inflation target, real volumes of goods and services would have to increase by 3 to 4% a year. So either consumers need to spend less, productivity needs to increase, or both need to happen. You see, as consumer prices drop and wages remain high, we could see a sudden pop in consumer spending, and that ultimately drives up the prices again in the future, known as demand pull inflation. And this isn't a new argument either. Fed officials have been concerned about wage growth for a long time now. The problem is that job vacancies are also high at the moment. So if companies are struggling to fill their jobs, it gives workers much more bargaining power over their wages, so wages naturally go higher. According to the Federal Reserve's projections, unemployment would need to increase to 4.1% to slow inflation down to something more consistent with the 2% inflation target. At the moment, unemployment is at 3.8%. So what exactly is going to create that higher rate of unemployment? Well, unless the Fed wants to push the economy into a recession and create more layoffs, it's not exactly clear. But the latest NFP data did offer some hope as unemployment increased slightly and wage growth did start to slow, a sign that previous rate hikes might be having some sort of effect. As Treasury Secretary Janet Yellen said this week, the labour market is cooling but without significant layoffs. At the recent Jackson Hole meeting, where central bankers from around the world meet up and give speeches, Jerome Powell sounded pretty hawkish. Hawkish meaning someone that's leaning more towards interest rate increases. Now, he highlighted that getting inflation down would require some below-trend growth and a softer labour market, both achieved by higher interest rates. Now, something to keep in mind is that we may actually see inflation move up to around 4 to 5% due to something known as the base effect, where the decline in monthly inflation data last year makes annual inflation data this year look higher. So a boom in consumer spending and potential for the base effects to distort inflation data means the threat of inflation and higher than expected interest rates is still very real. It could also be a more long-term problem if inflation stabilizes at a high level, like 5%. So that gives the Fed more room to tighten policy even further and could ruin this narrative of achieving a soft landing. Just because current data points are trending towards a soft landing doesn't mean that can't change before the end of this year. If inflation and wage growth remain high, they'll likely have to continue to raise interest rates and hold them higher for longer in order to slow the economy down even further. That reduces the chances of the economy experiencing a soft landing. So all in all, it's still too early to conclude whether a soft landing has or can be achieved, even with the positive indications that we're seeing so far. The Federal Reserve is expected to hold rates where they are at their meeting this week, but there's still plenty of time left this year to take further action.